Welcome to Talk Tickers, where we break down the numbers and the narratives that move the markets. Today, we're diving into Saratoga Investment Corp's third quarter earnings call. Now, management spun a tale of stability and caution, but we're here to dig a little deeper. Let's get into what the numbers really say and what it means for the stock going forward.
So here's our game plan for today. We'll start with the headline numbers, how they did versus what Wall Street expected. Then we'll unpack management's steady-as-she-goes narrative. After that, we'll see what analysts were really grilling them about on the call. And finally, we'll give you our take, what we're predicting for the next quarter.
All right, first things first, let's get right into the numbers. How did Saratoga actually stack up against expectations this quarter? Well, to put it simply, it was a clean sweep. Saratoga came in and beat expectations on every key metric. We're talking GAAP earnings per share, adjusted net investment income, and total revenue. Just looking at the raw data, you have to say this was a very, very solid quarter. But it's not just that they beat. It's by how much. They posted a GAAP EPS of 74 cents, a full 15 cents higher than what analysts were looking for. That's a 25% beat. That is not small potatoes. It's the kind of outperformance that definitely gets your attention. So you're probably wondering, how'd they pull that off? Well, a huge piece of this puzzle is their absolutely exceptional credit quality. Get this, a staggering 99.8% of their loans are rated in the highest possible category internally. They have only one single investment on non-accrual. In an uncertain economy, a portfolio that clean is a massive advantage. And to top it all off, the company went ahead and declared a quarterly dividend of 75 cents per share. For a business development company, or BDC, that's a huge vote of confidence. It signals that management feels really good about their earnings power, and you can bet income investors were paying close attention to that. Okay, so the numbers look sharp, no doubt about it. But what's the story behind those numbers? Let's get into the narrative that management was weaving for investors on their call. The big message, if you boil it all down, was one of extreme prudence. They really hammer home their focus on disciplined underwriting, taking small, steady bites for growth, and of course, keeping that dividend stable. The message between the lines is pretty clear. They are not out there chasing risky, high-flying deals. They're all about protecting the portfolio. And look, this quote from the CEO, Christian Oberbach, it really says it all. In a market that's been pretty choppy, their game plan is all about playing defense, protecting the company's value, keeping plenty of cash on hand, and being ready to pounce on the right opportunities, not just any opportunity. Now, that's management's side of the story, but what were the analysts, the folks on the outside looking in, really poking at? The Q&A session is always where you find the interesting stuff. So, what was the big question on everyone's mind? It really came down to this. Okay, you're being careful, we get it. But where is the growth going to come from? How are you actually going to move the needle? And this slide really gets to the heart of that discussion. On one hand, you see they brought in over $72 million in new deals, which is great. But on the other side of the ledger, they had almost $55 million in loans get paid back. So the net growth was positive, sure, but it's this constant dance of origination versus repayment. And management was quick to add some critical context here. They pointed out that the credit market is just plain tough right now. The profit margins, or spreads, on new loans are pretty thin, and the overall M&A market, while getting better, still isn't what it used to be. This whole environment really explains their cautious, steady-as-she-goes approach. All right, so that's the full picture from the last call. But what does this all mean for the next one? Let's dive into our analysis, our rating, our prediction, and the core investment thesis for Saratoga. First and foremost, you just cannot ignore this credit quality. It is absolutely rock solid. In a market where a lot of investors are nervous about a potential slowdown, having such a clean loan book is Saratoga's single biggest strength. It's a huge source of stability. And hey, don't just take my word for it. This chart puts it all into perspective. Saratoga's non-accrual rate, that's loans that aren't paying them back, is just 0.4%. The industry average, 3.2%. That means their portfolio is performing 8 times better than their peers. That's not just good, that's best-in-class underwriting on full display. Thesis point number 2, that dividend feels very, very safe, thanks to that strong credit performance. But, and this is a really big but, if they want their net investment income to actually grow from here, they have to put their available cash to work. The engine is built, but right now, it needs more fuel. And that brings us to the main event, the potential catalyst for this stock. Saratoga is sitting on nearly $400 million in what we call dry powder. That's available capital just waiting to be invested. This is their war chest, and it gives them immense flexibility to fund new, profitable investments. This is the primary lever they can pull for future earnings growth. So let's put it all together for our next call prediction. We're expecting Q4 adjusted NII per share to be pretty flat, maybe slightly up, as any new deals they make will have to offset those tighter profit margins. Because of that, we see the stock price as likely being range-bound. That excellent credit quality provides a solid floor, but the lack of a major growth catalyst puts a ceiling on it for now. This leads us to assign a market perform rating. Look, this is a high-quality company, but the market is going to want to see that dry powder get put to work in a meaningful way before it re-rates the stock higher. And as always, just a quick reminder for everyone, this analysis is for informational purposes only and is not financial advice.